Liberty Home Equity Solutions next Thursday is going to do a webinar showing you exactly how much money you can make on reverse mortgages.
Wow.
You know, one thing that's always lost is what's in it for me.
Yeah.
I mean, we're all basically driven by what's in it for me.
Yeah.
Well, find out. And let me just put it this way. There's a little extra cash, which will be a little more apparent from the show, as things stand right now, on reverse mortgages.
Yeah.
And if things change as the show, that's a precursor, comes true, there could be even more. So one of the best things you could do is figure these suckers out. Let Liberty Home Equity Solutions let you guys know. All you have to do is click this banner right over there. If you're on your mobile, scroll all the way down below and click the button. And here's my point, Frank, exactly what we were talking about. Apparently a whole bunch of mortgage companies and the Mortgage Bankers Association, they want the CFPB to change loan officer compensation.
Okay.
You want to know why?
Yeah, why?
Well, because the way it's set up right now is stupid.
That's right, it's stupid, man. I mean, right now, you gotta make the same amount on each deal, or else you don't.
Yeah, like you know, you're saying, okay, I'm gonna make more on this type of transaction or this loan amount than this one. If you start going down that road, you know, you understand.
Yeah, you're gonna go into the murky waters of, is it compliant?
And that could be problematic.
Right.
And we all know the problems with that, right? If you have to set your comp, like I said, for a market that has a median loan amount of, say, $400,000, you may set your margins more thin, right? Which is more competitive with the people around you, but you may serve different communities, right? Like ones that are not so affluent,
Yeah.
the less affluent.
Yeah.
In that case, your thin margins that you already set means you're just not doing that $100,000 deal.
Right.
Because there's not enough money on the table, in some cases, to even make a profit.
Right.
Now, the unintended consequence of this now LO Comp is set up right now is that fewer mortgage companies and loan officers are working less fortune-rich communities. That's code for poor people.
Okay.
And it really hurts the underserved, doesn't it? And really, that sucks.
It does, and not to mention if you neglect the underserved portion of your business footprint because you can't make money because of LO Comp, you not only hurt those communities, it also makes you guilty of desperate impact.
Right.
And thus could theoretically have you facing punishment.
Right.
I mean, getting punished because how LO Comp is set up. It could very well be mathematically impossible for you to make money and to be compliant. Hence, this is why this is so stupid.
It's one of the reasons. One last point that I need to bring up here, Frank, and this needs to be addressed if we're really going to talk about loan officer compensation. And this is intended for the general public, not necessarily the loan officer, okay? The idea behind loan officer compensation as it stands right now, as it was changed, it's to give you a fixed fee per transaction, the loan officer. And that's to ensure that that loan officer is not gorging him or herself on their clients, that being you, by making massive amounts of money. And that's a great idea. You know, you can't pick one income for one fella and another higher amount for another fella just because maybe you don't like him.
Right.
So this is all in general a good idea. The problem is loan officer compensation does not, I repeat, does not stop or stem the flow of money on these transactions. All that money prior to loan officer compensation is still all of it being paid out, and there's a lot of it. The changes simply dam the flow of money at different points, and usually they're upstream.
Further, it's created scenarios where companies have become creative in different ways of getting that money to their loan officer.
Right.
Maybe a different title, or a salary, or a bonus, or expenses, or expense account. In short,
Right.
It's made the flow of money in the mortgage industry decidedly less transparent because it's disguised as something other than loan officer compensation.
And further, it hurts consumers, okay? How things are set up right now. Simple one here, guys. In the past, if a loan officer screwed up his deal, and it still happens, they could simply pay for their mistake.
True.
You know, hey, I don't lock the loan, or oops, I didn't get your paperwork together on time, so I didn't get your loan submitted, or I missed that and I should have asked for it. In the past, that loan officer could take that out of their own personal commission because they screwed it up. Now, that, my friends, is accountability, right? And accountability is good, isn't it? Well, we don't have it anymore. Or have we gotten so wayward in our individual and collective priorities that being accountable no longer matters? I honestly do wonder about this. I mean, listen, if you screw up, and we all do, I don't hate you for it. I do expect you to pay for your mistake, if it is your mistake.
Sure.
And I hold myself to the same standard. Now, tell me why having that level of accountability is a bad thing.
Yeah, well, I mean, we could go on forever, but suffice it to say, though loan officer comp had noble intentions, it doesn't work all that great. And more importantly, we know better solutions, man. And not making those changes that ultimately hurt everyone involved would be a mistake and would not be noble at all.
No. So right now, there's 250 senior executives from different companies, and they've all signed a letter from the Mortgage Bankers Association asking the Consumer Financial Protection Bureau to make loan officer compensation more or less the way it was before, the smarter way. Make those changes and make it a priority. Now, of course, there's more to it than this. Not the least of which is these companies that sign this right now, they're all killing each other by setting their margins too low and working at losses in some case. Loan officer compensation would help fight that.
Gonna make a change.
Giving this type of control over loan officer compensation back over to the loan officer, to the company, to change the margins, to stay competitive, okay? This helps the consumer. When more can in fact compete at lower individual rates, those loan officers, to get these deals done. Anyways, this is in motion right now, guys, and if I know Mick Mulvaney the way I think I know Mick Mulvaney, he's going to make that change.
You know, the problem is loan officer comp was big, expensive, and changing would be admitting fault, you know, to a lot of people and agencies, but it's just the right thing to do.
Yeah, you know, and that's part of the issue that we have here is this is such a big undertaking that to roll that back right now and admit that fault, you know, but my whole thing is the only thing worse than a bad decision today is holding on to that bad decision tomorrow, regardless of what the cost is.
Absolutely.
So hopefully they make these changes and understand, because primarily it's going to help consumers. It's going to help the less fortunate, those on the lower middle class and the lower income rungs of the scale.
Right.
And it's going to, of course, make everything more transparent. So make that change.
Well, we'll see what happens. Let us know your thoughts in the comments down below. Do us a favor, forward the show, share it with other people, subscribe if you're meeting us for the first time. We'll catch you later here at the National Real Estate Post.
Later, guys.